UnitedHealth stock is down nearly 40% year to date after just all around terrible news. First off, UnitedHealth has cut their complete year guidance in 2025, reducing their expected earnings per share for the year. Also, they've experienced huge increases in their medical costs, which have decreased their profit margins and which has in turn reduced their earnings. Also, they've had a lot of CEO issues after their CEO got assassinated, and they've just had a lot of CEOs, and they've also had a lot of CEOs just resign and retire also after the assassination. So there's been a lot of questioning about who the CEO really will be for the long term. And then also there's a Medicare fraud that is happening with UnitedHealth. The Department of Justice is investigating UnitedHealth where they have potentially lied about their billing practices, which has potentially created more money than they deserve from Medicare. So with this being said, I'm going to be taking a look at UnitedHealth stock and seeing if this huge discounted price could give us a good buying opportunity to make a good return. First, I'm going to look at 7 metrics that I personally look at every video and I personally do for my own companies that I own. Then at the end of the video, I'm going to be using my intrinsic value calculator to determine the price I'd be willing to pay for UnitedHealth. The first 2 metrics that I like to look at for my 7-step stock analysis are based on the valuation of UnitedHealth. So the first 2 metrics are the trailing PE ratio and the forward PE ratio, which gives us an idea of where the stock is trading at compared to their earnings per share. So the first thing I'm going to look at is the trailing PE ratio, and I want this to be greater than 0, showing that UnitedHealth is a profitable company. And as we can see here, they have a trailing PE ratio of 12.68, which is actually also very low compared to the S&P 500, which means the lower the PE ratio, the less you're going to be paying for $1 of earnings per share from a company. So normally this does look good for a company, but also we need to make sure they're going to be growing in the future to be paying such a low valuation. But comparing to the stock market trades at about a 25 PE ratio. So this is about half the stock market compared to the value. So that looks pretty good. However, the forward PE ratio, we want this less than 30. And yes, it is less than 30 at 13.32. But I would like to add that I do not like that the forward PE ratio is higher than the trailing PE ratio. The trailing PE ratio is the earnings per share from the past 12 months, and the forward PE ratio is the earnings per share in the next 12 months. And if the forward PE ratio is higher, that means they're expected to have less earnings next year compared to last year. So that does make sense, which is why they did cut their guidance, and it does show that their earnings per share is expected to be less this year than last year. So it shows that they're going to be declining. So that's not good, but once again, the 2 valuation metrics do look good though. So at least those are 2 check marks. The next metric that I'm going to look at is the revenue growth rate. And this gives us a value of the amount of sales that UnitedHealth has had. And as we can see here, it has been growing over time, which we want this greater than 5%. And it's definitely greater than 5%. And on average, they're growing at about 10 to 12%. So this is definitely good for UnitedHealth. And so far, there is no negative years, so this looks really good for UnitedHealth, going from $88 billion to $410 billion in revenue. So UnitedHealth is actually one of the largest revenue-generating companies in the entire world, so this is pretty insane out of UnitedHealth. Now taking a look at the net income, we also want this to be growing at a greater than 5% rate. And as we can see here, this is also growing at a greater than 5% rate. However, they once again had some profit margin issues in 2024, but they just had a huge rebound in their net income. But I'm going to make a guess that this is going to start to decline in the next year or 2. But I think in the future, we can definitely see a rebound in that net income. But I do think that the profit margins are going to slightly decline in the next year, which makes sense because they did cut their earnings per share guidance. But nonetheless, this still looks like really good growth out of UnitedHealth. So the valuation for UnitedHealth at a 12 PE ratio looks pretty low for this amount of growth out of UnitedHealth. So that is a good thing. The next metric that I really like to look at, and is one of my favorite metrics, is the shares outstanding. And if the shares outstanding decrease over time, that means us investors will actually hold a greater percentage in UnitedHealth. And also, our earnings per share will go up over time. Even if they have flat earnings, as long as they buy back shares at a decent rate, you're still going to get a return on your stock. So this looks pretty good for UnitedHealth since they're buying back shares at about 2 to 1%. So it's not insanely fast buybacks, but they are buying back nonetheless. And I would really like to see United Health start to buy back in the next few quarters. And in the next few quarters, if they buy back a lot of shares, that's how you know this company could be confident in the future that they're still going to grow at a good rate. And they should be buying at these prices, especially since they said they are confident in how they are going in the future. So I would really like to see in the next few months that they are buying back even more shares than they did in the past few years. But nonetheless, they still are buying back shares at a decent rate. So I like that about United Health. The next metric that I'm going to look at is in the balance sheet. And this gives us a view on the debt of United Health. And like us, we don't want to have a lot of debt compared to the amount of cash or equity we have. So we want to see a less than 50% total debt to equity ratio. If we see less than 50%, that means they have less than half the amount of debt when compared to their equity. So we want to see a less than 50%. However, with United Health, we can see they have a 77.28% total debt to equity ratio. So this does look pretty high for United Health, but it's still not terrible. But it is an X because I want this less than 50%. But I would like to add, if we take a look at the total cash compared to the total debt, they have about $34 billion in cash, while they have about $81 billion in debt. So it doesn't look very bad. Say they use all that cash to get rid of their debt, they would have about $60 billion in debt or so. But if we take a look at the free cash flow, they have about $20 billion in free cash flow. So it would only take them about 3 years to pay off all their debt. So normally we would like to see it less than 5 years with the free cash flow. So this looks good, but the total debt to equity ratio is pretty high for me, but it's still not terrible. And the final metric I'm going to be looking at is the analyst expectations for UnitedHealth's growth rate in the next 5 years. And I want this to be greater than 5%. And as we can see here, analysts still expect them to grow at 9.6% each year over the next 5 years. Even with their earnings guidance cut, they're still expected to grow at a pretty good rate. So this still looks good for UnitedHealth, and they're trading at a very low valuation. So this could be a hidden gem potentially. Now the final thing that I'm going to be doing for UnitedHealth stock is using my intrinsic value calculator that I created to determine the future price I think UnitedHealth will be at in 10 years and to see what price we should pay to get a good return on UnitedHealth. So the first thing I have to look at is the future revenue growth rate for UnitedHealth. UnitedHealth's been growing at about a 10 to 12% each year over the past 10 years. While I do not think they're going to grow that fast, I think they can grow at about an 8% rate each year. Because if you take a look at analysts, they expect them to grow at about 9 to 10%. So I'm going to be slightly conservative compared to the analysts and say each year they're going to grow at 8%. So with that being said, I think in 10 years they could have a revenue of $885 billion. So that's a very high revenue in the next 10 years. But right now they're at about $410 billion. So I think it's very reasonable. Now for the future profit margin. Their profit margin has been very consistent at about 5 to 6%. So I'm going to be on the safe side and put 5%. So I think that's fair for UnitedHealth. And I think in the next 10 years, they'll have a net income of $44 billion. Now for the future P/E ratio. Right now they're trading at about a 12 P/E ratio like we saw earlier in this video. So I think that's a little too low for UnitedHealth, especially with this growth rate. I would say that there is a lot of competition in the healthcare business, and also the future profit margin is very low. Their profit margin is very low. So I don't think that they deserve a premium compared to the market, but I do think that they definitely deserve a higher than a 12 P/E ratio. So I'm actually going to put in a 17 P/E ratio for UnitedHealth. That could be a little bit high, but I think that's fair for UnitedHealth. Now for the shares outstanding. They have about 910 million shares right now, and I think each year they could buy back about 1% of their shares, which is in line with what they've been doing over the past few years, so that's pretty fair to me. And with this being said, I get a future share price of about $914, and I think if you bought this today with these assumptions, you could make about a 20% return on your investment. So if we go back to that future P ratio and say I think a 15p ratio is even more fair. I still think you could make about 16.89% if you bought this today. So I think if you take a risk and bought United Health today, you could have very good returns on this company and definitely beat the market if you believe these assumptions. So I would still be a little bit careful of this company and do more research, but I've been very intrigued to buy this company, but I personally am waiting till it gets in the 200s again. It's right at about $300 per share. I've just wanted to get about 280s. I think that's a good price. I might add some. But with that being said, thank you guys for watching this video and do more research on this company because I think this could be a very good buying opportunity. But thank you for watching. Please hit the subscribe and like button and see ya.